Hello, Vetted VA community. My name is Hammer. I am here for your weekly mortgage market update, joined this week with a guest, Mike Alberico. Today is August 23rd, 2023. Mike, thanks for joining us. Please take a minute and tell everybody a little bit about yourself. And when I say a little, I mean like a little.
Yeah, appreciate you having me on again. I am a loan originator out of Raleigh, North Carolina. Been with Vetted VA since the start. And I'm actually looking forward to hear what you have to say today because I see green on the screen.
Yeah, but that's only short-lived, and only you as a loan officer knows what that means, as a mortgage broker knows what that means. So we'll loop everybody in and tell everybody what Mike is talking about. If y'all have questions, though, we are here to answer them for you. And feel free to post those questions as we are going here live. We'd be glad to answer them. If you're here live, let us know. Say hello. And if you're watching on the replay, do me a favor. Just put hashtag replay in the comments. Let us know that you are here. Share this with other Vetted VA community members. Tag somebody if you want and let them know what's going on. I know a lot of people are frustrated with what's going on with rates right now. We're going to give you some insight into why we are seeing what we're seeing and which direction things are likely to go from here. So if you're on the replay, go ahead and let us know. And with that said, I mean, let's go right into the rate recap and we'll kind of talk about where things are at. Remember, when we talk about rates, this is not an offer to lend. And when we talk rates, we're talking about averages and generalities. You want to make sure that you're shopping around and that you're checking out your unique situation and that you're comfortable with who you're working with. So all of that good stuff said, since last week, rates have continued to move higher, as I warned you was likely to happen. However, some good news today is a little bit of a reprieve, so we'll talk about that in a moment. But overall, rates, if you compare them today to a week ago, are still higher. Rates are averaging, VA rates are in the sevens. Mike, are you even seeing anybody in the sixes? And if they are in the sixes, I'm guessing they're probably paying points to get there.
Yeah, we could still get down in the sixes, but there is some discount cost to get there today.
Yeah. So, and we'll talk a little bit more about what that means and how you can do that. But generally, if you're being quoted rates in the sevens right now, that does not mean somebody's trying to take advantage of you necessarily. That's where the market is. Conventional, if you are not getting a VA mortgage for some reason, conventional rates are averaging in the mid to high sevens, sometimes even in the eights, depending on credit score and the amount of money putting down and what the unique loan scenario looks like. So my little meme from last week, still relevant. These are not the rates you were looking for. But these are the rates that we're stuck with for now, and likely to see very similar rates for the near future. And let's kind of talk a little bit about that. So basically, I don't know why it went backwards. Let's go forwards. There we are. So this week, we could see rates move higher from here, especially on Friday. So what's happening this week? Fed Chair Jerome Powell, he's going to be speaking at the Jackson Hole Symposium a couple times a year. All the economic, actually all the central bankers, not all of them, but the Western central bankers, we're going to have, I think Christine Lagarde will be there. A lot of people from Europe and from our own Fed will get together and talk economies here for a couple of days in Jackson Hole, Wyoming. So Fed Chair Jerome Powell is scheduled to speak on Friday, which will be the second day of the symposium. It's a 3-day symposium. And he's going to be talking about the state of the U.S. economy. And traders are going to be listening for that. And the reason traders matter is that mortgage rates are based on what's going on in the markets. And I'll show you that in a minute. So, as far as the forecast goes, rates are likely to move a little bit further still. I think we can see them move higher. We will see some windows of improvement, which we're actually seeing today. But any improvements we do see are going to very likely to be small and short-lived. And let me show you guys what we're seeing and why, and Mike, for yourself as well. So this is the Japanese candlestick chart that we can use to share with y'all on what's going on behind the scenes. So mortgage rates are actually based on mortgage bonds, and we watch a multitude of bonds, and those bonds that we actually monitor will change depending on where the economy is and what rates are at. So we've recently made a change from the 5.5 coupon to the 6.0 coupon. Not really anything but a bunch of jargon, but for those of you that may notice that difference, I'm just kind of discussing it. But basically, we want to watch this pattern, and I'm going to move this into a line chart so it's a little bit easier for all of us to just kind of comprehend and be comfortable with. So looking at this line chart, as this line moves lower, it's inverse to the mortgage rates. Mortgage rates test, and where am I at, and which network am I on, and am I back, Mike?
You're back on my side.
Okay. Yeah, that is. I have 3 different internets. I'll have 3 here in the Smoky Mountains. That is, I'm currently on my Starlink, and it appears that it had a. Sometimes it'll do that for about 8 seconds. Anyway, going back to where we were back in March, we saw some of the better mortgage rates. That was when this line was at its highest. And you can see that as it moves up and down, mortgage rates change. So unlike the TV commercials back in the 90s, it's not a bunch of old white men around a round table from the banks that say, ha, 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 we're going to set these evil mortgage rates. It's actually depending on what's going on in the overall economy and specifically with these particular bonds. Now, as this line goes down, as I pointed out before, you guys are going to see mortgage rates move higher. And recently, if we look back, this is August 9th. This was August 4th. We've seen this line move significantly lower day after day after day after day. And we saw mortgage rates that have just continuously pushed higher and higher and higher each day. Now, right now, we're seeing a very big rebound. We've got a really nice high line going on here. And that means that mortgage rates today are going to be better than mortgage rates that we saw yesterday. And they're probably going to be better than mortgage rates that we saw maybe through into the middle of last week. Now, this line, though, what you'll see on this pattern is a lot of times we'll go down and then it'll come up. We'll go down and then it'll come up. So we usually see it come up. And this has to do with traders trying to take advantage of different opportunities. Again, I don't want to go 20 minutes talking to you guys, boring you about what goes on with bond traders. But what we call this is a consolidation trade. And it's very likely that we'll see this improvement today, maybe even tomorrow. And then especially depending on what happens with Fed Chair Jerome Powell on Friday, we're likely to see rates start to move in the upward direction again. So if you are currently under contract and you are not locked in, you may want to discuss with your mortgage professional that locking in today, possibly tomorrow, you may have a little bit of a window where rates have improved, and it's going to be different for different scenarios and different lenders. Mike, what have you seen this morning for rate sheets? Have you seen much of an improvement over yesterday? And if you were to say an average, what do you think it would be?
Not a whole lot. And I've been doing this 10 and a half years. I'm not nearly as good at reading data, but what I've learned over the years is when we've seen the MBSs, the chart you were just talking about, decline, honestly, for like 8 business days straight over the last week and a half or so. We saw such a sharp jump up today that I think a lot of the investors are probably going to hold back some of that yield spread to see if this is short-lived, especially with which you covered the meeting on Friday in Jackson Hole. So we've seen some improvement, but not nearly enough to kind of get super excited.
Yeah. And if we were to go ahead, let me throw this screen and pop this back up for a second. So let's basically here, when we look at, come on, I had it up. There it goes. So why mortgage rates change? And that's what we're talking about. So mortgage rates are based on the bond market, specifically mortgage-backed securities. And the better or worse they're performing, the better or worse rates are. Now, I wanted to see, okay. Now, rates will vary from different lenders when this happens, especially because lenders are working with what they call margins. Basically, everybody is starting out with very similar rates to begin with. But what happens through this process when we look at what happened on that fancy chart, that's what we have is called wholesale pricing or secondary pricing. And then depending on how that trickles through the system before it gets to the consumer, how many layers it has to go through, and how each of those layers, how much profit each of those layers needs to bring, that's going to make a difference on what you as a consumer pay. So let's pretend we're going to use a round number just to give some examples to this and make some sense of it. Let's say that you were given a rate of 7%, as a mortgage rate. Well, let's say that started out on the back end. In the secondary market, let's say that, and again, these are made up numbers and this is an oversimplification, but this is kind of put it in perspective. Let's say that rate started out at 6% at the lender, and the lender can sell your loan to the secondary market to have it securitized to replenish their funds. So that way they don't run out of money and they can continue to lend money on a continual basis. Let's say that they're selling it at 6%. And again, this is not really how it works, but it breaks it down for you. So let's say they're going to sell it at 6%, but you're going to get it for 7%. Well, that 1% in the middle, that is divided up, and that's going to be between the lender and how the lender has to maintain a profit. But right now, there are just much fewer loans out there than we've seen the last few years. And that's because, as you guys know, when you're out there looking for homes, there's a lot less homes out there, very tight inventory. So putting rates being high aside, just the fact that it's hard to find a house to buy, and hard to find a house that you want to buy, and hard to get your offer accepted when you want to buy it. All of that has to do with keeping the number of loans down. And then with rates being up, there's less demand. So lenders are doing less loans. Well, it still costs the same amount to rent those buildings and pay that staff and keep the lights on. So what's happening is that the lenders have to make more money per loan to keep the lights and everything on. And this is sometimes can be especially true when you look at those big lenders, the box lenders, like, Veterans United and Rocket Mortgage. These are big companies that are, have to give to shareholders, and they still have to make profit. They're still, this is a big focus for them. So you're going to find that there ends up being a very large discrepancy. Now, Mike, you're a mortgage broker, so you know that as a broker, there's a little less fat in that deal. So what happens is what started out at 6%, and the lender might turn it to say let's say 6.5, 6.5%. And then if they are what's called a retail lender, they've got to pay their staff, they've got to pay their originators. So maybe that gets to the consumer at 7% that way. And if they're a mortgage broker, in your scenario, you're actually working directly with the consumer, and the lender is going to pay you for your services. Sometimes the broker can pay directly, but most often it'll come from the lender. And that's where the other margin is going to be there. So sometimes you may be able to work at a lower margin than other mortgage companies. And that's why somebody might say, hey, why am I seeing 7, but yet this other person wants 7.25? And it doesn't mean that they're trying to take advantage of it. It just means that they've got higher costs, or maybe they're requiring a little bit of a higher profit. And that is the difference. And that's why you as a consumer need to be aware. That's why we're here to teach you, so that you guys can shop around it and be comfortable. Mike, what do you want to add to that? Because this is directly in your wheelhouse.
Yeah, there's lots of other things that factor into it. Like when it comes to a conventional loan, which is backed by Fannie and Freddie, they have a set chart of what are called loan level price adjustments, industry terms, LLPAs. VA, which Ginnie Mae is the pool that handles those, does not have set loan level price adjusters, those LLPAs. So those can actually vary greatly between lenders. And when I price out a VA loan, I can look at pricing from 4 to 6 different lenders at once if I want to. And a lot of times we'll see that the individual lender may have different adjusters for a lower credit score. Like one lender may adjust up a lot more for below a 620 credit score, where another one may not have that big of an adjuster. Other things that can factor in there are loan size as well as property type. One of our lenders has a very large adjustment on manufactured housing, and the other one doesn't. So you could have the same scenario and the same cost to do that loan, but you might see a 0.5 point difference between the two lenders because of those adjustments.
Yeah.
The other thing we're seeing on the back end is, what to piggyback on what you were talking about, is there's not a lot of business, and the investors make money off long-term performance of loans. And the reason you might see costs and rates going up is the investors aren't stupid. They know that rates will eventually come back down, and the majority of these loans are going to be refinanced away. So they're not going to be a long-term performing asset. So they can't really give away the credits like they used to in the past on the front end, where, during COVID times, if we had the lowest rates in history, there were credits even and VA rates in the 3% range. Most of those loans are still performing well, and they're not going to go away unless that homeowner has to sell them or they pay it off. I mean, a lot of the people that got these mortgages at the lowest times are flipping them to investment properties, which is also putting another squeeze on our housing market. So it's a ton of factors that go into what dictates the cost of a mortgage. Yeah. And it's hard to, we could talk about this for hours, which we're not going to, but it's hard to do it. But the point being is shop, because it can vary. Like
Yeah.
we even have some of our wholesale lenders that'll do pricing incentives. Like, hey, we want to boost our
When they're
VA.
hungry for business. Exactly. So, you've got lenders. When Mike's is a wholesale lender, what we mean by wholesale, there's two channels that are generally in the mortgage business. We have what's called retail and wholesale. Retail, I work directly for the company that's handling all of the loan. They're doing all the underwriting. They're selling it on the back end. And then I'm an employee of that company. That's called retail. Just like if I worked retail for Walmart. Now, wholesale is Mike is a mortgage broker. So Mike owns his own company. He works for himself. And he is working directly with a wholesale lender, and that lender finds that it's maybe more cost effective to utilize brokers like Mike instead of having their own retail staff. So that's a wholesale lender where Mike can go and get that money. Now, you as a consumer can't work directly with a wholesale lender. You need a broker in between who can work with that wholesale lender or shop around with different wholesale lenders. So they may turn around and Mike can say, okay, I can go to Target, I can go to Walmart, I can go to, well, not Kmart anymore, but just to throw them all in there. I know they don't all fit, but say Target, Walmart, Lowe's, Home Depot. He could shop around at the different stores. Whereas if you walk directly into a Home Depot, you can only buy the things that are there at Home Depot. So that's your difference that you'll find there. And that's why shopping around and not some people feel one channel is better than another. I don't necessarily think it's the case. There's merits to working with both. It depends on your unique situation. And you can have very aggressive pricing amongst any of those. But on the wholesale side, when times are lean like this, we do see that they compete for your business. They compete for Mike's business. So he may see those pricing specials that he can help you to kind of grab and take hold of. So, did that sum that up pretty well, Mike?
Yeah, I mean, there's competition always drives down costs. It's one of the best things, and it's real competitive right now. So the lenders I work with are competing for the business that I bring them, which helps drive down the cost. And like the incentive piece, it can vary. Like, I might have somebody that says, hey, we want to boost our VA portfolio. We're going to give you 25 basis points credit on every loan you send us. To put that in English, it's $250 credit for every 100,000 you finance. So you're buying a $400,000 loan, they're going to give you an extra $1,000 to reduce your closing costs, which is ultimately benefits the consumer, because that doesn't go to my brokerage. It doesn't go to the loan officer. That trickles down to the person signing on the bottom line.
Right. So let's go ahead and hit this one. So one of our members said, I read narrative yesterday in the forum. What is your opinion on rent versus buy? Rent is nationally lower cost than buying right now. So first of all, let's stop right there and talk about you've hit a generality, right? So nationally, renting is cheaper than buying, but it's so much of a market by market situation where you're at. Are there even any homes to rent? Are there apartments to rent? So you've got to look at it for the geographic situation, rather than looking at national numbers. But while locally, regionally, it is obvious circumstantial based on demands and supply, which we just talked about. So are these rates over treasury bonds? How does that impact the future given the eco-political damage is done and won't take effect till spring of next year? So this one's got quite a few things going on. As far as rent versus buy, that's really comes down to the question that we get all the time, which is why should I buy a house now? And then we'll talk about the eco-political very briefly. We don't want to go too deep on that topic, but we'll talk kind of a little bit about that one. But why should someone buy a house now? Why is now still a great time to buy a house, Mike?
It like you said, it's regionally. Like I'm in the Raleigh market, which is known as the Triangle. It encompasses Raleigh, Durham, Chapel Hill. We have hundreds of people relocating here a day because our economy is strong. There's jobs being added. Apple set up a campus here and everything like that. And so that really drives up housing on both sides, whether it's the rental or the purchasing piece. So it really is going to be regionally. Same thing with just south of me in Fayetteville and Fort Bragg area. Those housing prices are staying pretty level. They do appreciate, but you have to look at where you're going to be renting at and the appreciation of value, say if you're stationed at Fort Bragg. So it really is, it's case by case, honestly. And I'm helping a retired vet right now. He's moving closer to eastern part of North Carolina because his daughter just had a baby, and he found a place to rent there, and it was $1,850 a month. They're going to raise it to $2,000. And he bought a place for basically 300 grand. He's paying 2,300 bucks. So yeah, he's paying a little bit more, but hopefully he'll have an opportunity to refi once rates do tick down to get that payment back down. But he'll also, he owns this place. He's not paying somebody else 100%. So that's in a scenario where it is a little bit higher, but it's definitely worth it.
It's like a savings account. He's building equity on the property plus, and again, there's one thing that we need to throw out there, right? We are in a market where housing has gone up either a lot or a little, but it really hasn't gone backwards that much, at least certain pockets, certain California pockets and things, but overall, it really hasn't. Now, we can't guarantee that home prices are always going to go up, especially if you look maybe 1 or 2 years or year over year. But if you look over 5 years or 10 years, we know that everything gets more expensive, right? And including housing. So he's not only paying down his mortgage and building equity, but most likely he's building equity that is because the houses around him are selling for more money, and that's going to bring his home value up, and you build equity that way. So there's the financial reason. And then the other reason on rent versus buy is just, you're in control. You can paint the walls whatever color you want. You could poke holes in the wall. You could put a slide in your living room. You can do whatever you want when you own the property. When you rent, it's a very different story. Some people are okay with that. Some people are not. So you have to know, for both the financial and other reasons with family and things like that, whether you want to rent or buy. And as far as the financial reasons go, a few things to be aware of right now. Number one is that when rates go up like they have significantly over the last couple of years, more so than we've seen, I think, almost in any time. And what should have happened is home prices should have dropped. They should have fallen, because there is a relationship between rates and price. And at the center of this relationship is affordability. So there's a fulcrum of affordability. And as one side, let's say rates go up, the other side, which is prices, has to come down so that they can meet in the middle at that affordability factor. And as one side go down, home prices go up. Again, because of that affordability factor. Now, what you'll notice, you can see in the headlines, talks about how we have the least affordable housing in, I think, 28 years. And the reason for that is because of the inventory. We have a lot of unique factors at play this time around. When rates went up, home prices should have fallen, but they didn't. Why not? Well, because people don't want to move. They have a 2 or 3% mortgage. They don't want to move into a house where they're going to take on a 7% mortgage. People are not, they're aging in place is a term that gets used a lot now. We have a problem from, we're still feeling repercussions from 2008, 2009, 2010, when building dropped and the floor fell out on the housing market. So we have less homes being built and more regulation. So there is tremendously less inventory, which is keeping the prices up. So even though rates have increased, which brings demand down, the demand still outpaces the supply. So you're in a situation right now where, normally we would see this move. Well, what's going to happen is that when rates go back down, and they will drop eventually, and they're never going to drop to those lows again unless we see another pandemic situation, but they're going to go down at some point, because that's what rates do. They're cyclical. They go up, they go down. And we know that eventually the economy is going to falter. The Fed is going to lower the Fed funds rate, which is going to trickle through the entire economy and all of the different rates that are out there, credit card rates, car loans, all that stuff. And those rates will come down. And when that happens, home prices, they're likely to move higher, because while that supply is keeping the prices artificially up, it's not going to keep them artificially down. And supply will continue to be an issue on top of rates being lower with higher demand. So if you were to be buying a home right now, there's only a couple of things that, number one, you never want to be in a situation that you have to guarantee that the home is going to increase in value, because you can't, it's like any other investment. You can't guarantee that. And some things that could cause our home market to slow down or crash, we'll never see a crash, but we could see a crash, is if we see the labor market tank, and if we see the credit market tank. And I'm going to talk more about this next week, because we're running on the end of this one. And I think I'm going to pre-record next week's show, and I'll talk about what's going on in the credit market and how that could affect housing. But for now, what you want to remember as far as it comes to that question, and like what Mike had said, is that when you're looking at home prices, the reason you want to buy now financially is that you're in a better situation, that you can buy a home that's not going to be at what should be a lower price right now. And when rates drop and the value goes up, you got the home at a lower price and you could possibly refinance to that lower rate. So that's why you've got that. Does the presidential election affect mortgage interest rates? It affects everything, but to how much of an extent is going to be argued, and it's different. Like it was different when Trump ran in 2018. I think it was 2018, 2016. I've lost 2016. So we had many things that were different then versus what'll be different now, and how the economy is going on. There's a lot of things that happen that are blamed on politics that have nothing to do with politics. There's some things that really are due to politics that we do see a change. But one thing, the one thing that we can all agree on right now is that the forecasting is broken. 6 months ago, I told y'all we'd be sitting here pretty and rates should probably be dropping as we sat knee high in a recession. Well, we're not in a recession and rates are not dropping. In fact, they're the highest they've been since the 2000s, since the aughts. So that shows you that forecasting, even though, hey, it's just like that hurricane going into California. We think it's going to go in this direction and then the wind shifts and instead it blows out to sea. And instead of a category 5, it's a tropical storm. And that's exactly what happens with the economy. So we give you guys some insight. I try to give you some thoughts on why I think things are going to happen. But then you've got to remember, you got to be prepared for what we're really dealing with today. So, Mike, what do you want to add to that? And then we'll wrap up.
That was the general consensus, not just with you, but with other rate experts and economists, is y'all were pretty much in agreement, not up to 100%, but that we were supposed to be seeing the floor soon. Yeah. And we haven't. So it is always hard to do it. I mean, only thing I'll add to that is, just get a one-on-one talk with a realtor and a mortgage professional if you're thinking about buying, because it may not always be the best for you, but most of the cases it is. If you're in like a civilian job, you're going to be in one area for a year, then yeah, you're probably better off renting. So just, it's case by case. Don't use what we're giving you as a guideline, but always look at your individual situation.
Yeah. And, and renting can, sometimes, like Mike said, can be the right move. But overall, even if we do see homes lose value in the future, the longer term will definitely see homes go up in price. It's, it's what happens with everything. You don't buy a car for $4,000 anymore. In fact, I bought a Jeep Wrangler in 2012. I spent $34,000. I bought one in 2020. I spent $55,000. I was just pricing one the other day and it was up to $67,000 for the same model of the Jeep that I have now. $67,000. Look, and will that go down? Not much. Not gonna happen. So that's kind of where we're at. Mike, is there anything you want to leave everybody with before we wrap up?
No, I appreciate you having me on, sir.
No, thanks again. Thanks for being with us, everybody. Make sure you join us next week. We will be here at the same time. Where's my little next week thing? Where's my little banner? There it is. Join us next week, 12 o'clock Eastern, 11 a.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. And next week, I will go a little bit deeper. I'll tell you guys about what's going on in the credit market, what's going on with consumer credit. It's hit a record high, why that is important, why that could affect the housing market, and what we should be looking for. Next week, we're also going to see some jobs data. We're going to see the job openings and labor turnover survey. We're going to see the non-farm payroll data, wages. We're going to have unemployment. So there's going to be a lot going on next week that could affect things. So we'll be talking about that. Thanks again, Mike.
See you guys.